Hello, my dear future chartered accountants. This is CH in my Hegde. This problem, what we are going to do now, is on Ind AS 28. A special problem which has been added in the CA Institute study material applicable for the coming exams and subsequent exams. A very special problem, unique problem. A problem like this have not been asked and not even maybe heard of. Let us read the problem and I will solve it. Then I'll show you I'll compare it with the institute solution at the end. Let's read. And once I read the problem, I'll also explain you the concept. An entity has the following three types of interest in associate. One type, equity shares. 25% of the equity shares to which equity method of accounting is applied. I hope you know what is equity method of accounting. What is equity method of accounting? I am an investor. I have an associate. So I have made the investment in associates, which is shown in the standalone, independent, separate financial statement. But in the consolidated financial statement, I will take the investments and I add the share of profit from the associates. So journal entry will be investment account debit to P&L, consolidated P&L, and that is called as the equity method of accounting. And of course, loss, what happens if it is a dividend, what happens, all those things you would have heard of, you would have learned, which I'm not going to talk about it now. Of course, loss, I'm going to talk about it now. Let us read further. Preference shares, non-cumulative preference shares forming part of net investments in associate. Such preference shares are measured at fair value as per Ind AS 109. Long-term loan carrying interest at 10% per annum. The interest income is received at the end of each year. Long-term loan is accounted as per amortized cost as per Ind AS 109. This loan also forms part of net investment in associate. So as an investor, I have shares in a company. I have preference shares in a company. I have equity shares in the company. I have invested in preference shares of a company. I have invested in associates of, loan of a company. So I've invested in equity shares. I've invested in preference shares. I've invested in loan. So equity shares, I follow equity method. But preference share and loan, I don't follow any equity method. So it will be part of net investments. So for the investor, it will be an asset. For the other company, for the associate, it is going to be a liability, either in form part of shares or in the form part of loan. If it was a subsidiary consolidation, then we would have set off like mutual owings. But in a case of associates, set off will not happen. We'll continue to show it. That is, on the asset side, only in the consolidated financial statements, investment in equity shares, we follow equity method of consolidation, equity method. Add the share of profits. But for investment in preference shares, investment in loan, we are not going to eliminate anything. We will continue to show it in the consolidated financial statements on the asset side. Investment in loan, investment in preference shares. Since it's part of the associates, we call it as net investment in associates. That's all. So you don't have to think anything beyond that. Only point what to be kept in mind. When I prepare consolidated financial statement on the asset side, in the consolidated financial statements, I'm an investor. On the asset side, what do I write? Investment in associates. In shares, equity method, cost of investment plus share of profit, outer column, investment in equity shares. Then below that, net investment in preference shares, the outer column amount in long-term loan, outer column amount. Understood? In the consolidated financial statements, we will have three assets. Investment in shares, we follow Ind AS 28 equity method. Investment in preference shares, investment in loan, I'm calling it as in net investment in associates, for which I apply Ind AS 109. For the preference shares, I'm following fair value method. For long-term loan, I'm following amortized cost method. Hope you know these things in the financial instruments. Let's read further. At the start of the year 1, carrying value of each of the above interest is as follows. Equity shares, investment in equity shares, investment in preference shares, investment in long-term loan. Following table summarizes the changes in the fair value of preference share as per Ind AS 109, impairment loss on long-term loan as per Ind AS 109, and entity share of profit or loss associates for the year 1 to 5. Okay, let's read. They have given the data for 5 years. Change in the fair value of preference shares. Remember, for preference shares, we will follow Ind AS 109 fair value method. So what they're telling, first year fair value decreased, second year fair value decreased, third year fair value increased, fourth year fair value increased, fifth year fair value increased. So this is the data applicable for preference shares. Three types of assets are there: equity share, preference share, loan. So preference shares we have done. Next we have loan. What that loan? Impairment loss within brackets or reversal of that impairment loss as per Ind AS 109. You know, when you follow amortized cost method, financial instruments, amortized cost method, Ind AS 109, you don't recognize any fair value change because you follow amortized cost method, but you will provide for permanent diminution, that is what? Impairment loss. ECL method and all, hope you know that. Financial instruments, expected credit loss method. Should I make a provision for 1 year or should I make a provision for entire future years, permanent lifetime loss? Anyway, that is financial instruments. So when you follow amortized cost method, you will provide for only not fair value change, not temporary change, a permanent fall only, which is impairment loss. So in the loan, first year there is impairment loss, second year there is nothing, third year positive 50,000 means that impairment loss is reversed. So whatever impairment loss happened, only that maximum you can reverse. Beyond that you can't reverse. The reversal of impairment loss is limited to impairment loss. That's why you see minus 50,000 and then plus 50,000. Entity share of profit or loss in associate. This is applicable for investment in equity shares. 16 lakh loss. Share of profit. On this you don't have to do any 25% and all. This itself is share of profit. If associates loss was some 10 lakh, then to get to know your share, because you're having a 25% share, you're having a 25% share, you do into 25%, you get 2,50,000. Correct? But here they have given the heading, read carefully, entity's share of profit itself is given. So no need to multiply it by 25%. So this is applicable for equity shares. So loss 16 lakh first year, 2 lakh second year, nothing, no profit, no loss for third year, 10 lakh profit next year, 10 lakh profit next year. Okay, so all these things happened. The data given. Okay, some more data point given. Let's read further. Throughout the year 1 to 5, there has been no objective of evidence of impairment in the net investment in the associate. The entity does not have any legal or constructive obligation to share of losses beyond interest in associate. Based on the above, determine the closing balance of the interest at the end of each year. Let me explain these two sentences. Throughout the year 1 to 5, there has been no objective of evidence of impairment in the net investment in associate. In the sense, there is no objective evidence in the impairment of net investment in associates. So once we calculate this profits and losses, impairment loss, share of profit, fair value adjustment, we get one amount: investment in shares, investment in preference shares, investment in loan. Put together, we'll call it as net investment. So put together, is there any loss to be provided further? See, individually for preference shares, I follow fair value method. If there is a fair value loss, I'll account for it. For a loan, I'll provide for loss if there is impairment loss. For share of loss in associates, in equity shares. So individually, I have done the impairment testing. That is any decrease in the value of the asset. Decrease in the value of preference share will come by way of fair value change. Decrease in the value of loan will come by way of impairment loss. Decrease in the value of investment in equity shares will come by way of loss, whatever loss happened. So together we will write net investment in associates. Should I make a provision for further loss? Why should there be a further loss? Who knows? There might be credit rating issues in the company, or company is having a situation of liquidation. So whatever going concern assumption may be affected for whatever reason. The amount of whatever you're showing now, if it requires further impairment, then you have to provide. You remember in the impairment standard, Ind AS 36, right? We provide individual impairment at an asset level. Then we provide the impairment at a CGU level, larger CGU level, like for goodwill, corporate assets, like that. We test the asset at an individual level and also part of a group level, which we called as CGU. Same logic applies here. Investment in preference shares, investment in equity shares, investment in that is a share of profits of in equity shares, share of loss from associates for equity shares. Individually, we provide the losses. For preference shares, fair value loss. For the loan, impairment loss. For the equity shares, share of loss from associate. So independently, individually, we have done the impairment loss adjustment. But together at a group level, you might have to provide for further impairment loss like a CGU. That's what they're telling. There is no impairment loss required. So that way they have helped us. No further impairment loss. So we have to do impairment calculation, loss adjustment calculation only at a individual level. We don't have to do it at a higher level. This itself is enough to trouble you students. We don't have to trouble ourselves with some more troubles. When it comes, we'll solve it later. One more sentence, let me explain. The entity does not have any legal or constructive obligation to share of losses of the associate beyond its interest in associate. This is limited liability concept, my dear friends. Forget about this sentence. You are a shareholder. You have invested in the shares of a company. Reliance Communication, Kingfisher. Share price was 5 rupees. You purchased 1000. So 1000 into 5 rupees, 5000 rupees worth you invested and purchased the shares. Kingfisher closed. Should you pay anything more than 5000? If it was a partly paid up share, then you have an obligation to make the payment. And some exceptional cases, you have to pay beyond things like unlimited share capital. But limited share capital, companies limited by shares, the limited liability concept. As a shareholder, as an investor, my liability will be only to the extent whatever I have already invested. If that is a loss, that can become zero. I don't have to put anything out of my pocket extra. Not required. That's what they're telling. That is, entity does not have an obligation to share the losses beyond interest in associates. So whatever the investment amount we show, that is the maximum amount of losses I can reduce. In the sense, if my investment is 5 lakh and if I have a loss of 6 lakhs, I will not show my investment 5 lakh minus 6 lakh minus 1 lakh. I don't show. I limit my loss to 5 lakh. Balance 1 lakh, I will not recognize because of limited liability concept. Okay. So, hope you would have understood by now. This problem is entirely about losses. Definitely relevant at this point in time. Because of the corona situation, everybody is suffering loss. You, me, everybody. Physically, medically, financially. So this problem is entirely about losses. Anyway, this problem is connected with corona, but the loss element is what we are trying to understand. Okay, so let me tell you the one basic concept, and then we will go further towards the calculation. Okay, suppose investment in equity shares, investment in shares, equity shares, investment in equity shares of associates. We follow equity method for the time being. For the time being, let's say there is no preference shares, there is no loan. Let's say there is only equity shares investment. So if you invested at a cost of 1 lakh, that is your cost of investment. Share of profit you will add next year when the associates make a profit to the extent of your share on accrual basis in a consolidated financial statements, you are going to add share of profits. Let's say that comes to 20,000 in the current year. Next, if you receive any dividend, you are going to subtract, and that is what is called as equity method of accounting. Anyway, we'll keep that aside. Let me subtract next year, second year, I have a loss. Loss means what? You subtract, that's all. So, share of loss. How much loss? 1 lakh 10,000 loss. Oh, 1 lakh 10,000 loss. So 1 lakh plus 20 was 1 lakh 20,000. Now you subtract 1 lakh 10,000. I'll just write 1 lakh 20 here itself. 1 lakh 20 was the investment value. Share of loss 1 lakh 10,000. And now it becomes 10,000. Oh, so much of loss. Maybe corona effect. Next year again loss. Share of loss. Share of loss. Next year again, next year how much loss? Loss 12,000. These are all imaginary numbers, okay? These are all the conceptual part only, imaginary numbers. I'm giving you the concept first, then I'll do this problem solution. 12,000. Now, if I subtract 12,000, I will get only negative 2,000. Investment I cannot show negative. Negative means I have a liability now. I don't have extra liability beyond my investment. My liability restricted to my investment. I cannot subtract 12,000. I can only subtract 10,000. Balance 2,000 will become unrecognized loss. What will happen? It becomes unrecognized loss. So this you will have 0. Investment in associates, you will be showing 0, and you say 2,000 loss carried forward, unrecognized loss. Loss incurred, it is my share of associates, but this is beyond my investment value, my carrying value, so I will not be recognizing the extra loss like a loss carried forward. Next year, suppose you have a share of profit, things are back like a stock market, everything is back, you get share of profit. How much share of profit? For the time being, let's assume share of profit is 5,000 rupees. Now what should you do? 5,000 rupees. I have to add 5,000 rupees. But I will not add 5,000 rupees fully. You know what will happen? 5,000 rupees fully. That is not correct. What will happen? There was a loss carried forward the previous year. Loss unrecognized in the previous year. You set off that first. What was the loss which is not yet recognized? You recognize, in the sense you adjust balance profit only, you recognize. What is the impact? I'll show you. You calculate first. These are all imaginary numbers. So 5,000 profit you have, carried forward was 2,000. So you set off, carry forward, set off, like income tax. So balance 3,000 you get. Therefore, investment amount will become 3,000. Investment amount will become 3,000. Okay, so what is the impact? Why are we doing this carry forward and set off? Carry forward, you understood. I cannot show you a negative number because our liability is restricted to the amount of investments. Why should I do set off? I'll show you the amount now. So overview now. Cost 1 lakh. Cost 1 lakh. Share of profits first year plus 20,000. Next year minus 1,10,000. Next year minus 12,000. Next year plus 3,000. So please tell me what will be the net amount. Plus 20,000 minus 1,10,000 minus 12,000 plus 3,000. Let me calculate. So 20,000 minus 1,10,000 minus 12,000 plus 3,000, that is 20 minus 1,10,000 minus 12 plus 3. 20 minus 1,10,000 minus 12 plus 3. 99,000. Some issue. What is the issue? 1 lakh plus 20, 1 lakh 10, 10,000. 12,000. So 2,000 carry forward. Sure. Oh, sorry. Last year was 5,000. Sorry. Last year was 5,000. 3,000 is after set off. 5,000 is share of profit. Last year was 5,000. So 20 minus 1 lakh 10 minus 1 lakh 20 plus 5. Minus 12 plus 5. Minus 97,000. Okay. So minus 97,000. So what will be the net amount now from beginning to end? 1 lakh cost of investment, 97,000 overall share of loss, balance carried forward, balance amount 3,000, which is what? Exactly the investment amount now. Hope you got the concept. Delete everything from your mind. What should you have it in mind? You will recognize loss. You subtract from investments. You subtract from investments. When you have a loss beyond investment, when you have a loss beyond investments, you should restrict the loss to the investment. Balance loss will be unrecognized and that will be carried forward. Next year, when you make a profit, you first adjust the loss. The balance amount you should add to share of profit to get the carrying amount of investment. Hope you got the concept. This problem is going one step further ahead. What is one step further ahead? In this problem, what you have to do? Loss in investment in shares. If you have a loss, restricted to investment is fine. But if my loss is exceeding the investment, I just told you, you have to carry forward to next year. But in this case, apart from investment in shares, you also have investment in preference shares and you have investment in loan. So what this standard says, if the loss, unrecognized loss is there in the equity share, then you pass it on to preference shares. If still some more amount of loss is there, then pass it on to loan. Like what you have in Income Tax Act, right? If you have a loss from business, you cannot set off against salary income, but you can set off against other income. You can set off against capital gain. I think capital gain may not be allowed. I don't know. Anyway. So, when you have a loss, first you show it to equity shares. If you have a further loss, then you transfer that loss to preference shares. If you have a further loss, then you transfer it to loan. If you still have further loss, that you carry forward, you set off in the next year. Sir, what if next year profit comes? Whom should I given the profit? Don't give it to equity share first. Give it to loan first. Understanding? So when you have a loss in associates, this you can write down. I'll give time to write down. Loss in associate. First adjust against investment in equity shares. Adjust against investment in equity shares of associate. Investment in equity shares. Basically, equity method you follow. Okay. If you have a further loss, then you go for investment in preference shares. If you have a further loss, then you go for investment in loan, long-term loan. So basically, this is the order of liquidation. So what the standard says, when you have investment in multiple instruments, if you have a loss, then that should be adjusted against all these instruments in the order of liquidation. So when liquidation comes, you pay the loan first, then you pay the preference shares, then you pay the equity shares. So basically it's actually reversal order or liquidation. But when you, this is for set off, okay, this is for set off. If you have to this is for carrying forward, adjusting the loss. This is for loss against investment. Loss against investment. If you cannot adjust against investment in loan also, then you carry forward. Then you carry forward. Okay, and next year you are going to do set off. Next year you are going to do set off. In which order? You don't give it to the equity share when you make a profit. To whom will give you profit first? Don't set off against equity share. First set off against investment in loan. Then you set off against investment in preference shares. Then you set off against investment in equity shares. So this is in the order of liquidation. So if a liquidation happens, whom do you pay first? Loan. Next, whom do you pay first? Shares, shareholders. Then whom do you pay first? Equity shares, right? Equity share comes at the last. So basically, the carries loss when it happens, adjust the loss in equity share, preference shares, loan. When reversal happens, go in LIFO method. Don't go FIFO method. Since equity shares are loss first, preference shares are loss next, loan is loan next to loss. Don't go in that order for reversal. When you want to do set off, subsequent year you can carry forward and there's a reversal, right? You carry forward, then you set off. But subsequently, when you make profits, you have to reverse the previous ones. You have to reverse all our losses. You have to reverse all these amounts of losses. But reversal should happen on LIFO method. Basically, that is in the order of liquidation. Hope you got it. I'll write once more so that you can also write along with me. So when you have a loss in associates, first you adjust against investment in equity shares, basically equity method. Then you adjust investment in preference shares. Then you adjust against investment in loan. If you have a still, then that will be loss carry forward. Loss carry forward. Okay. Then you will set off. You will set off against profits. Next. You will set off against profit when the associates start making profits. That comes in the reversal order. So you first set off, first you recognize the profits. First, whatever the loss recognized with respect to loan, everything you adjust. Then you adjust against preference shares. Then you adjust reverse against equity shares. So reversal. First will against the loan. Then you reverse against preference shares. Then you reverse against equity shares. So basically this they say in the order of liquidation. Order of liquidation. Reversal. This my handwriting is reversal. So when you loss comes, equity share comes first. But when profit comes, after all this reversal, equity share comes at the last. But one more special points are there. All these investments, before you adjust these losses, first apply Ind AS 109 first. Apply Ind AS 109 first, because you will have impairment loss individually, impairment loss for preference shares, impairment loss for loan, etc., or fair value change for preference share. So first to apply Ind AS 109, then you come to this investment value. What exactly this point? When I solve this problem further, you will understand. I'll give you 2 minutes. You can note it down, or you can take a picture if you understand my great handwriting. Okay, very good. Okay, hope you have taken down. I'll go further about the solution now. Okay, fine. So let me first come to the year one. I'll do the same format in institute which I solved the solution. You can present in different format also. Let me do for year one. Okay, so we have whatever type of investment, like investment in shares, like that type of investment. Then we have opening balance. Then Ind AS, I told you first Ind AS 109 you have to apply. Ind AS 109 adjustment. Then you apply share of profit or loss of associates. Then closing balance. Okay, same format I'm going to apply. So type of investment for first year, in equity shares. In equity shares, I'll use short forms. What is the opening balance of equity shares? Equity shares we have 10 lakh. Opening balance 10 lakh. Ind AS 109, any adjustment is there? No. Equity share we don't apply any Ind AS 109 because we follow equity method. So nothing will come here. So you can say don't apply also. You can say not applicable. And share of loss. How much is share of loss? Look at the share of loss. 16 lakh is the loss. But I have only opening balance 10 lakh. So how can I adjust? Balance 10 lakh only. I cannot do 6 lakhs. Because we don't have any obligation beyond our investment, limited liability concept. So I can only adjust 10 lakh. Closing balance becomes 0. Sir, loss is 16 lakh, a share of loss is 16 lakh. Hold on a second. 16 lakh we have adjusted against equity shares. But in this problem, we have investment in preference shares also, investment in loan also. But before you adjust the loss against the investment in preference shares, before you adjust the loss against investment in loan, first you provide for Ind AS 109 adjustment, which is what we are having in our column also. So let me write the balance. Balance amount is 5 lakh and 3 lakh. So 5 lakh and 3 lakh. Okay, now Ind AS 109 adjustment for preference share 50,000 loss adjustment, for loan also 50,000 impairment adjustment, subtract minus 50,000 minus 50,000. Hope understand. Subtract for both of them 50,000 50,000. Subtract for preference shares, reduction in the fair value, for the loan reduction in the impairment loss 50,000. Now first whom should I given the loss? After equity share, first you should give it to preference shares. How much loss? 5 lakh is the balance. 50,000, Ind AS 109 coming. Balance 4 lakh 50. Entire 4 lakh 50 you can take. Entire 4 lakh 50 you can take. Subtract. So 5 lakh minus 50,000 minus 4 lakh 50,000. Entire balance you have adjusted against the losses. Closing balance became 0. What about our share of loss? Remember, 16 lakhs we had a share of loss. We have adjusted only 10 lakh. We have adjusted only 4 lakh 50,000. Still remaining is there. That how much loss? 1 lakh 50,000. Correct? 10 lakh plus 4 lakh 50 plus 1 lakh 50 comes to 16 lakh. So 1 lakh 50,000. So still loan amount, balance amount continues. 3 lakh minus 50,000 minus 1 lakh 50,000. That means 1 lakh. So investment in loan, we have 1 lakh. What if the loss was 17 lakhs? 1 lakh loss more. Adjust against this amount of carrying amount of loan 1 lakh. Sir, what if loan is loss is 17 lakh 20,000? The extra 20,000 becomes a loss carried forward to the next year. Against we provide for a equity share first when you want to adjust the loss. So loss means equity share comes first. Profit means equity share comes at the last when in terms of reversal. Okay, so this is for year 1. So net investments when you show the consolidated financial statements, net investment in associates, you will be showing 1 lakh. And I told you, net investment in associate, there is no further impairment test to be done at a CGU level, group level, not required here. At a CGU level, group level, not required here. So 1 lakh will be investment in associates, net investment in associates in the consolidated financial statement. This is for year 1. Hope you are clear. Let me go for year 2. Please write down parallelly along with me. Same heading will come. I don't repeat the heading, but this I have to repeat. Investment in equity shares, investment in preference shares, investment in loan. The amounts are previous year closing balance becomes current year opening balance. 0, 0, 1 lakh. Okay. Now, Ind AS 109 adjustment. How much Ind AS 109 adjustment in the second year? Come to the second row. Equity share nothing. Again, equity share not applicable. For loan, there is no impairment loss. Share of loss will come to it later. 50,000 loss is there. 50,000 loss. 50,000 loss. This is a very, very interesting, important situation. Please listen to me carefully. In my opinion, if at all there is complication, if at all student can go wrong, this is the first mistake they can go wrong. Our opening balance is 0. That means we don't have any carrying amount. But as per Ind AS 109, we have to provide a 50,000 loss. Sir, investment value only not there. How will you recognize a loss? How will you recognize loss? So, what do? Previously, whatever the profit we have recognized, I will reverse. I will make it forcefully carrying amount. Shall I repeat this concept once more? Investment in preference shares, our carrying amount is 0. But we have Ind AS 109 fair value loss. You do whatever you want, fair value loss must be accounted. You can't give excuse. You cannot say 0. So fair value adjustment, market value change must be reported, reflected, recognized. How do we recognize? Investment value is 0. We are going for one exceptional situation. Mark this adjustment important. I create investment value so that I can provide for loss. How do I create whatever my loss previous year, entire amount I don't recognize, whatever the loss I have to provide, 50,000 is going to be reversed. So this is reversal of loss. Why I'm reversing the loss even though they are not making profits? I want to share, I want to recognize, I want to report this Ind AS 109 adjustment. So whatever happened earlier, I am going to reverse 50,000 to that extent so that closing balance becomes zero. Hope you got that point. Now what is the impact of this? Nothing in loan, right? Nothing in loan, zero. Now we have a loss, further loss, 2 lakh loss, further loss, 2 lakh. So to whom we are going to adjust against the further loss, so 2 lakh. The 2 lakh loss we are going to adjust against equity share only, obviously, because loss comes. We have not yet started set off. So loss you give it to equity shares, which is 2 lakh. Sir, how will you say 2 lakh, sir? Because zero investment in equity share, so I cannot show zero. So this is zero. This amount becomes zero. In loan we have, sir. Okay, loan you recognize. How much loan you can show? 1 lakh. Should I show full 1 lakh? Yes, yes, show it, show it. Zero. So 1 lakh you will show, recognize. So 1 lakh loan was there, 1 lakh you set off, this also became zero. So this at the end of the first year, everything is zero. But there is some loss which is unrecognized. How much loss is unrecognized? How much loss, share of loss? Please pay attention. Many people might do mistake. Of course, many people don't even do this problem. But even if you try, this is where many people can find something confusing. 2 lakh was the loss. 2 lakh was the loss. And 1 lakh we have adjusted against a loan. So balance, how much amount supposed to be there? Balance 1 lakh. But I will not say balance 1 lakh. Balance carried forward is 1 lakh 50,000. Loss carried forward, unrecognized loss, 1 lakh 50,000. Sir, explain once, sir. This is confusing, sir. No problem. I'll explain. Suppose the reversal of 50,000 had not taken place. What you would have done? Investment in preference shares, zero. Ind AS 109 adjustments, I can't really do any adjustment because my carrying value is zero. So share of loss also will not come, zero. So out of 2 lakh, 1 lakh I'm going to adjust against a loan. Balance carried forward, you say 1 lakh. Correct? But I have to provide the Ind AS 109 adjustment also, 50,000 fair value loss. So that 50,000 plus this 1 lakh total loss became 1 lakh 50,000. Mathematically, very simple concept. Please observe. How much loss was share of loss from associate? 2 lakh. 2 lakh was the share of loss. Now 50,000 we have reversed. So 2 lakh will become what number? 2 lakh will become 1 lakh 50,000? No. 2 lakh will become 2 lakh 50,000. Why? Because we don't have a profit to set off. I'm artificially setting off, which means I'm increasing my loss further. Understanding? I repeat once more, 50,000 is the loss which I have to remove, which I'm reversing in preference shares, which means whatever the preference share last year I have adjusted 50,000 loss, I'm reversing for preference shares. Okay, for preference shares you're reversing, but somebody has to share that loss. That 50,000 which is reversed, but still a loss because profit did not take place. So 2 lakh was the loss. 2 lakh was the loss. Minus 50,000. Why minus 50,000? Because if it was a set off, I would have done plus 50,000. But here I am doing minus 50,000 so that it is getting further adjusted. It's a very important point. So minus 2 lakh, minus 50,000. Sir, what is that? One more thing, sir. Simple concept. Listen to me carefully. You'll definitely understand this time. 2 lakh current year loss, 50,000 additional loss, fair value loss, total loss 2 lakh 50,000. But that 50,000 loss, I cannot give it to preference shares because that is fair value loss. I have to show it in Ind AS 109 only. So that 50,000 loss, I'm showing it in other two accounts, equity shares and loan. Basically, 2 lakh loss of current year, 50,000 loss of previous year. Effectively, I am recognizing in preference shares. Are still not understood, sir? Okay, I am trying my last method to make you understand this. If you understand, you understand. If not, go blindly calculation. Reversal, you calculate. Concept. Listen carefully. Listen carefully. Preference share previous year has recognized a loss of 4 lakh 50,000. Correct? 4 lakh 50,000 loss they have recognized. This year, I want to recognize the 50,000 loss in preference shares, but not as share of loss, but as Ind AS 109 adjustment. Okay, then what do we do? Okay, let's do one thing here. 4 lakh 50,000, no, I'll make 4 lakh. So, what will happen if I make 4 lakh? I will get 4, if I adjust only 4 lakh, my carrying amount becomes 50,000. I can show this impairment loss 50,000 now. Okay, but what about that 50,000 loss? Carry forward to next year. Understood now? 2 lakh loss of year 2 and 50,000 loss of year 1. Why 50,000 loss of year 1? Because I want to show in the Ind AS 109 loss specifically. So basically, Ind AS 109 loss is substituting share of loss 50,000 loss. So 2 lakh loss of current year, 50,000 loss of previous year. Why 50,000 loss of previous year? 4 lakh 50,000 was there, but 50,000 I am reversing, I am making it 4 lakh so that the balance will become 50,000. I can show Ind AS 109 50,000. My investment preference share becomes 0, but 50,000 loss was there previous year. That goes carry forward. 2 lakh of current year also carry forward. So 2 lakh 50,000 is the total loss to be carried forward. 1 lakh we are setting it off against the loan. So 1 lakh is adjusted. So 2 lakh loss, 50,000 loss, 1 lakh adjusted against loan. So 2 lakh plus 50,000 minus 1 lakh. That's how loss unrecognized carry forward becomes 1 lakh 50,000. I hope you got this point. Beyond this is not in my control. So carry forward. This is nothing but unrecognized loss. Unrecognized loss carried forward. Unrecognized loss carried forward. I'll explain you for the one last time. Current year you have a loss of 2 lakh. I adjusted against a loan 1 lakh. So 1 lakh is the carry forward. But I have to show 50,000 Ind AS 109 loss also. Total loss carry forward becomes 1 lakh 50,000. This is my best. I cannot go beyond this. I'll go to year 3. Year 3. In equity shares, in preference shares, in loan, in equity shares, in preference shares, in loan. So all the balances are 0, 0, 0. Second year closing balance is the third year opening balance. So 0, 0, 0. Okay. Now, what is Ind AS 109 adjustment? Fair value gain 1 lakh 50,000, reversal of impairment, equity share, no profit, no loss. So, third year, what will I do? Third year, Ind AS 109, gain, equity share, nothing, not applicable. Preference share, fair value gain, positive 1 lakh. And in loan, impairment reversal, reversal impairment also means gain only. So 50,000. Now what is my new carrying amount? In equity share, nothing. I can't do anything. In preference shares, we have 1 lakh. Loan, we have 50,000. Current year, no share of loss, which would have adjusted. Current year no share because no profit, no loss. But unrecognized loss is there. That you adjust now. 1 lakh, you make it against preference share first. Second, you make it against loan. So 1,50,000 unrecognized loss, entire amount is adjusted. So 0 for equity shares, 0 for preference shares, 1 lakh minus 1 lakh, loan also 0. Unrecognized loss carried forward now becomes 0. 1,50,000 was unrecognized loss. 1 lakh we adjusted, 50,000 we adjusted, so it becomes 0. So ultimately, this also becomes 0 at the end of third year. Third year, basically what happened, there is a gain in fair value gain for preference shares, there is a gain in reversal of impairment loss for a loan, and unrecognized loss was there, which was perfectly tallied, coincidentally perfectly tallied. If it was 1,60,000 previous year, 10,000 would have been carried forward next year. If this was 1,40,000, 10,000 extra would have come. Sir, what you told? Tell once more. Telling you once more. If loan amount is 60,000, I mean, you can't reverse 60,000. If preference shares you had 1,10,000. 1,10,000. So first you would have given to loan. First you would have given to preference share. So what you telling? Tell once more, sir. Okay, I'll tell you. This is a long problem. Preference shares reversal fair value gain 1 lakh. If it was 1,10,000. So out of 1,50,000, whom will you give the loss first? The loss would have given to the preference share first. Why? Because 0 opening balance, 1,10,000 gain, the carrying amount now becomes 1,10,000. First adjust 1,10,000 against preference shares, because first preference shares, first equity, then preference. In this case, no equity, equity has become 0. Then we have balance 40,000. 1,50,000 minus 1,10,000 means 40,000. You adjust against a loan of 40,000. The loan amount of 50,000 is the amount, because 0 plus 50 carrying amount is 50. 40,000 you adjust, balance would have become 10,000. Got the point? But in this problem, perfectly tallied, so no need to worry. So let us not complicate things further. Let me go to year 4. So let me write year 4. Same heading, opening balance, Ind AS 109, adjustment, right? A type of investment. Okay, first type of investment, opening balance, Ind AS 109, adjustment, then share of profit or loss, closing balance. So type investment in equity shares, investment in preference shares, investment in loan. All opening balances are 0. What is Ind AS 109 adjustment? With respect to equity share, nothing. So not applicable. Not applicable. With respect to preference shares and loan, loan is already reversed. Loan, whatever 50,000 impairment loss, 50,000 is already adjusted. Again, loan cannot come. So loan, no adjustment. Preference shares fair value is there, 50,000. Okay. Preference share value 50,000 and 0. For loan, nothing. Okay. This will increase the carrying amount. Yeah, that's all. 0 plus NA, 0. 0 plus 50,000, 50,000. 0 plus 0, 0. So at this point in time, the carrying amounts are 0, 50,000 and 0. Share of profits. Oh, be careful. Share of profits are 10 lakhs, sir. 10 lakh share of profit, to whom we will give in the order of liquidation reversal. Like a company is getting liquidated, we will pay equity share only at the last. We'll give it to loan first. Do give entire loan to, we give it entire 10 lakh to loan only? No, only to the extent of their share of profit, their share of loss. Sir, what's our loss? Look at year 1. Look at year 1. Look at loan. 1,50,000 was adjusted. Perfect, sir. And here how much loss? 50,000, sir. So 1,50,000, year 1 we adjusted. Oh, year 2 is also there, sir. Okay, year 2 also is there. 1,50,000 adjusted in year 1. 1 lakh adjusted in year 2. 50,000 adjusted in year 3. So total, what was the loan which took the beating? Loss. Adjusted against the carrying amount of loan, 1,50,000 loss, 1,00,000 loss, 50,000 loss. Therefore, that amount against the loan becomes 3 lakh. Got it? 1,50,000 plus 1 lakh plus 50,000. If you want, you can write somewhere. So you write 3 lakh, which comprises of 1,50,000 first year, second year 1 lakh, third year 50,000. Whatever the loss which we have adjusted against the loan is a first reversed. Got the point? Amazing. Great. Let's come to preference shares. Preference share, what is the loss, sir? 4,50,000 was the loss. 50,000 we have reversed because we have to adjust against the Ind AS 109 adjustment. So 4,50,000. If I remove 50,000, balance only 4,50,000 we have removed, and 50,000 we have 1 lakh in the third year. So 4,50,000 minus 50 plus 1 lakh. So I think 5 lakh, right? Correct, 5 lakh. So 5 lakh comes in preference shares. So this loan is first, preference share is second, balance amount will go to equity shares. So whatever balance amount, you need not worry about the balance amount for equity shareholders, because equity share anyway balance entirely will go to equity shares only. So how this 5 lakh comes? Let me show the calculation. First year was 4,50,000. Second year we had removed 50,000 so that Ind AS 109 loss can be reported. And third year we have adjusted 1 lakh plus 1 lakh. So 4,50,000 plus 1 lakh minus 5 lakh, 4 lakh, 1 lakh, 5 lakh. That comes to 5 lakh. Balance amount. What is the share of profit? Third year profit is 10 lakh. Out of 10 lakh, 5 lakh goes to, 3 lakh goes to loan. 5 lakh goes to preference share. Balance 2 lakh. Balance 2 lakh. This is calculated by 10 lakh. First you subtract loan 5 lakh, sorry, loan 3 lakh. Then equity share, preference shares 2 lakh, preference shares 5 lakh. So 10 minus 3 minus 5, you get 2 lakh. So what is the closing balance coming to? Equity shares, nothing was there, so you get 2 lakh. Preference shares 50,000, 5 lakh, 50,000 is already positive number, plus 5 lakh means 5 lakh 50,000. 0 plus 3 lakh, that becomes 3 lakh. So 2 lakh, 5 lakh 50 and 3 lakh. So 10 lakh 50,000. Perfect. Next, coming to year 5 in equity shares, in preference shares, in loan amount, in equity shares, opening balance is previous closing balance 2 lakh, preference shares 5 lakh 50,000, loan 3 lakh. Okay, what is the fair value into 109 adjustment? 30,000 for preference share, nothing for loan, nothing for equity shares. So equity share do not apply. Preference share 30,000, loan nothing, 0, no impairment. Share of profit, whatever supposed to be against the law is completely set off. Whatever against the preference share, completely set off. So everything share of profit goes to equity shares only, which is a 10 lakh. So entire share of profit goes to equity shares 10 lakh. So year 5, 10 lakh plus 2 lakh, 12 lakh, 5 lakh 50 plus 30,000, 5 lakh 80,000, 3 lakh plus 0, 3 lakh. So total becomes 20 lakh 80,000. This is what even your institute solution. I told you I'll show institute solution. You can just check it yourself. This same more columns are there, same format is there. You can check it yourself. So please write it down. Okay. Now, one more beautiful point I'll tell you. After all this circus, how the answer will look like ultimately. Please observe. Equity share was 10 lakh. Loss happened, adjusted against the loan, adjusted against the preference shares, then everything is adjusted backwards and it is back to equity shares. So ultimately, what is the balance should the truth should come? Okay, I'll tell you one beautiful magic. Sir, it's a magic. Yes, you will like it. Please observe. 16 lakh loss, 2 lakh loss, 10 lakh profit, 10 lakh profit. Overall, what is the net profit, sir? 10 lakh plus 10 lakh, 20 lakh minus 18 lakh. So 2 lakh overall profit. What was the equity share amount? 10 lakhs. So share of profit 2 lakh over a period of 5 years. Ultimately, what should be the balance? 12 lakh. Look at our final calculation, 12 lakh. Loss happened, profit happened, it went to equity share, it went to loan, it went to preference share, then it come back. Ultimately, it will be in the equity shares only, ultimately. Because whatever happened to loan and preference share, we reversed it because profit was earned. Simple verification. Sir, can I do for a preferential loan also? Easily. Please observe. Preferential was 5 lakh. Find out the net amount. $50,000, $50,000, 1 lakh a profit. So basically set off each other. Then 50,000, 30,000. Net amount comes to 80,000. So 5 lakh was there plus 80,000. So 5 lakh 80,000. Sir, 5 lakh 80,000 is the balance. Yes. Investment in preference share is 5 lakh 80,000 overall. Sir, loan, even more simple. 3 lakh was the amount, 50,000 impairment loss, 50,000 reversal, net amount 0. So 3 lakh plus 0, that is 3 lakh only. Continued. So 3 lakh, continued. One more small point, it is amortized cost method. What is amortized cost method? We are going to add interest income at the effective interest rate. We subtract any collection. So loan is carrying interest of 10%. We don't have any specific information about the effective interest rate. So under amortized cost method, loan 3 lakh, we add the interest income of 10%, then we subtract same 10%. So plus 30,000 minus 30,000. So no impact. That's why 3 lakh continued. One of the points you can note it down or you can mention under amortized cost method, interest is recognized, any interest received is subtracted, overall no impact. So that calculation is nothing to do with our impairment loss adjustment calculation, because 30,000 income accrues 10% on 3 lakh and 30,000 you receive it, that gets subtracted. As effectively the carrying amount is not getting adjusted. Sir, if interest rate was different from effective interest rate, yeah, then that also need to be considered. First you understand about this point, then you understand about other points later. Hope you got the point. So this is a new problem, a fresh problem regarding investment in associates, investment in equity shares, investment in preference shares, investment in loan. There is a loss, there is a profit, and you have Ind AS 109 adjustment. There is adjustment of loss, carry forward, set off, reversal of loss. Beautiful problem. Okay. Hope you got the point. Good.